Hey, this is John Lux. I want to talk about a new way to fund venture capital deals, a new venture capital model. Disclaimers: this is not investment advice. You need qualified advisors. The more you know, the more you're going to profit. Classic venture capital model is well known. Venture funding is the key to any new and growing business. And in the process, the company formulates a business plan. They try to get it reviewed by venture capitalists. If they're not well connected, this can be difficult. Venture capital firms see hundreds of business plans every day, and they fund only a few deals a year. If they're not in the latest fad industry, they may not get money at all. If the company's lucky, it's allowed to pitch to venture capitalists. If it's again lucky, it'll get a term sheet. After tough negotiations, a deal is struck. This can take 90 days until funding or more. At closing, the company is going to sign hundreds of pages of agreements. They may have to give up control. If not, they're going to give up a lot of control. And typically, they cannot sell their stock when they want to. Usually, as the company develops, money is not released until the milestones are met. If the milestones are not met and more money is needed, the entrepreneurs lose equity. They may even be fired. Investors and venture capital funds are only allowed one investment decision to back the VC team or not. They have no say in the VC team's investments in individual companies. They're locked in, and when the VC wants to liquidate, if the IPO market is dead or dull, the exit strategies are limited. Now there's a flaw most people don't realize in the venture capital model. Venture capitalists are motivated to negotiate tough terms and buy in at a low valuation. In bad deals, where the promoters are only trying to milk the venture capital firm for money, these people will accept harsh terms. Good deals will not. So the venture capital model is skewed actually toward getting the worst deals. New model I propose is the reverse merger model. The entrepreneurial team finds a public shell, they buy it, they merge in, they can raise money because the investors know they have an exit strategy with a public company. The company keeps control, determines their salaries, can get more funding whenever they want. It's limited only by investor demand. They can sell part of their stock early to get some cash, and they only report to the shareholders. Their problems are they have to pay for the shell, they may be attacked by short sellers, they have to do SEC compliance and audits unless they're in the pink sheets. From the investor's point of view, non-institutional investors can get in on the venture capital game. Their money's not locked up for years. They don't have to buy the whole portfolio. Their wins can exceed the highest VC fund returns, but the deals are very risky. They do keep control of their money, and they can sell when they want. Comparing the VC model with the reverse merger model, reverse mergers provide funding where it would not otherwise happen. The company and investors keep control. Terms are usually better for the company. Company's not second-guessed by venture capitalists. If you have a venture deal and cannot find fast funding or do not like the terms, contact me, John Lux, at lux.investor@gmail.com. Put venture deal in the email subject line. If we like the deal, we may cover all the costs. And we know everyone has a great idea. We want ethical team players who can make it happen. To learn more, subscribe to my videos on YouTube. Go to my website, www.reversemerger.info. Get my book on Amazon. Contact me at lux.investors@gmail.com anytime.